and welcome to your weekly GoNoGo show. My name is Tyler Wood. I am a CMT charter holder. And today, as always, I am joined by Alex Cole. How are you doing, my friend?
Very well, thanks. Good morning.
Good morning. Good morning. It's May 10th. It's a Friday. And I believe spring is upon us. It's certainly raining out here. Hopefully that helps the flowers. We'll see. Speaking of green shoots, we've had a few up days, Alex. Let's get objective about our view on markets. Let's take a look at trend across the asset classes, get a broad-based picture of the environment that we are all trading in.
Yeah, absolutely. And we have had a really nice little run off the lows from last month, enough to take GoNoGo colors on the equity markets out of NoGo and into these amber bars. As you can see, we've had a string of them, 5 amber bars in a row, which is quite unusual on the daily chart with prices moving this quickly. So still some uncertainty around, as you can see, with equities in the top panel, and also with the commodities. We've got some movement of oil going lower. Gold looks like it's holding where it is. So some sort of mixed bag with commodities as well. And that's, of course, why the US commodities index in that third panel is painting amber bars as well. Treasury bond prices in the second panel painting weaker pink no-go bars. And of course, we'll see what that means for rates as we go through the show. And then the dollar on the bottom panel managing to return to stronger blue bars as the week is coming to a close here.
Absolutely. And for those of you who are new to GoNoGo Charts, thanks for joining this weekly broadcast. What we're doing with this trend model is taking all of the technical analysis indicators that we know and love, the most widely tested, the most heavily used, and those that are objective and mechanical in their calculations. So you're not going to find a lot of seasonality mixed into this. We're not going to be using things outside of that traditional toolkit of trend, momentum, volume, and volatility. And just to take a second, Alex, on the trend model, the 5 conditions that can exist in a GoNoGo chart are strong and weak forms of a Go trend, right? So blue bars in that strong form of upward trending conditions. Aqua paints that weaker form, but still in an upward trend, right? So a trend in some period of exhaustion or contraction. Then we've got the same for no-go, or to the downside, when we have downtrends, a strong form in the purple bars, a weaker form of a downtrend in those pink bars. And then we've got the that level of neutrality. Markets can go in 3 different directions, up, down, or sideways and range bound. And we're very big fans of the life and work of Jesse Livermore. We talk about go and no-go in the sense of a NASA shuttle launch. You want all of the conditions to be optimal before you put billions of dollars of hardware on the launch pad. When we think about neutrality, we talk about these go fish bars, because Jesse Livermore was once famously quoted as saying, in all markets, there's a time to go long, a time to go short, and a time to just go fishing. So one of the themes that we're going to cover a lot of in today's show is this idea that you don't necessarily need to make a strong decision in one direction or another when the market is giving you this neutral reading, when it's still in the process of deciding. So we'll be talking about all of the signs and signals that we're going to use to let us know when the market decides which direction it's headed. So Alex, let's switch away from this asset class heat map. Let's pull up a full GoNoGo chart of the S&P 500. Take a look at this week's price action to the upside, but still in that neutral trend condition.
Yeah, what's interesting though is we've got surging momentum, Tyler, in positive territory. So you can see how we were in the go trend. We rolled over. We came through the colors. We spent some time actually in a no-go. But what we were looking for a couple of weeks ago was what was going to happen as the oscillator rose to test the 0 line. So what we want when in trend is for the oscillator to confirm. And so it'll do that by staying on one side of the 0 line, depending on what the trend is. So when we were in this go trend, this really strong, healthy go trend, you can see how the oscillator stayed at or above 0 the entire time, finding support at that level. The 0 line for us is an objective level that can be used as support or resistance when in a trend. And as you see us come to the end of this go trend, you can see the oscillator test that level again and then break below into negative territory. And that's our first sort of sign that there's something unhealthy in this go trend. We don't want any signs of overselling or excessive selling when you're expecting the market to be in a go trend. So we can see that led the trend indicator then to paint some no-go colors. We saw the technical environment change. And now we're in that reverse situation. We come back to test the zero line below now, and all else being equal, if this no-go trend is to be healthy, we would expect the oscillator to be rejected at zero. It wasn't. You can see how we burst into positive territory. That tells us that momentum is now no longer in line with the no-go trend. Momentum is positive. There's some signs of heavy buying. The last thing I want to point out here, Tyler, is this grid. This is our volatility indication. And when the oscillator gets stuck at the zero line, that means there's very little directional pull on either side. So it's that sort of visual representation, perhaps, of a tug of war between buyers and sellers. So as price moves sideways here, you can see that represented by the climbing grid of the GoNoGo squeeze. And that grid hit its max at a value of 6. And then, of course, it's important to know the resolution. And in this case, we broke into positive territory. And as we're seeing these uncertain colors telling us that this no-go trend for now is not anymore holding court. So we've got some uncertainty. We've got positive momentum as we've broken out of the squeeze to the upside. So it'll be very interesting to see what happens as we get near these prior highs. Will we re-enter a go trend and move higher? Or will we maybe perhaps fall back and see the no-go continue? So we'll be watching very, very closely. This is an interesting one.
Absolutely. And the interplay between what's happening in momentum, which is a leading indicator, and what the trend conditions are, that's built on lagging indicators, can be very powerful for an investor or trader to use those tools in combination. Certainly looking very constructive in that lower panel, breaking out of that max squeeze. We know from the great John Bollinger or looking at Keltner channels that when volatility has been compressed, the resolution, when it breaks in one direction or another, can lead to high velocity moves. And certainly we've seen a string of up days this week as that momentum oscillator broke out above the zero line, reversing out of the no-go trend into this neutral territory. Before we move on from the S&P, Alex, good practice for all technical analysts is to think about things on multiple time frames. So the way that our indicators are calculated, it's the same weightings in calculation no matter what the periodicity of the chart is. So we're looking at a daily showing us this area of uncertainty. Let's bounce this out to a weekly chart just to get a little more context.
Yeah, and this one is just exactly what you'd hope to see if you were bullish. You're seeing that support at the zero line on the oscillator now. The daily price action we've seen has been enough to give the oscillator some support, and you can see now a return to a stronger blue bar on the weekly. And that green circle, Tyler, tells us that we're seeing likely trend continuation. Circles for us are trend continuation icons. Green when in a go trend, red in a no-go trend. So we're seeing now go trend continuation on this larger time frame chart.
Absolutely. So that's our broader context. That's the intermediate period. If your execution time frame is on the daily, perhaps you're looking to that break to the upside for the momentum oscillator, for the GoNoGo oscillator, to give yourself a trade entry signal. So a lot to unpack here today. Let's move on from the S&P 500. Let's get back to those intermarket forces at play that we know have some impact on where equity prices are going. Let's take a look at the TNX, the 10-year Treasury yield of the U.S. markets.
Yeah, and 10-year Treasury yield is weakening. We've seen falling yields for the last couple of weeks. Seems to have found a little bit of support here. We see how we've sort of moved sideways for this week, generally speaking. But the oscillator in negative territory, so momentum out of step with the trend. So go trend, but weakening, and negative momentum for Treasury rates.
Absolutely. So still in go trend conditions, but we're pulling back, we're stabilizing, and we have negative momentum, perhaps even signaling the potential for a trend reversal. Let's move on from the TNX. Let's take a look at U.S. oil.
Yeah, U.S. oil was in a nice run, and we saw the same sort of situation play out that we were talking about with the equity markets, where in a trend, you want to see the oscillator support the trend by finding itself at or above zero. And you can see that it failed to do that in this most recent pullback. After the last high, we saw weakening aqua bars telling us that the trend was weakening. and then the oscillator failed to find support at 0. And that's, of course, that leading indication that something's not quite right with the trend. It came back to retest. We would have wanted this to regain positive territory quickly if we were going to expect the trend to continue, and it didn't do that. So we saw a first lower high, and then, of course, a move out of the Go trend colors into a no-go trend. So right now, looking at US oil, we're in a no-go trend. Oscillators rising and close to 0. So we'll watch to see now if it gets rejected at this level. If so, we'll look for price to make another leg down.
Now, the issue with U.S. oil or any commodities prices is that when we're seeing these in breakaway runs to the upside, that could be a challenge for the U.S. economy. And when you think about household spending week by week, prices at the gas pump, cost of heating houses, fuel oil, and then also in the industrial context, the rollover here in oil, it's not plummeting to the downside, which can also be disruptive, but rather stabilizing. And for a look on that, Alex, why don't we bounce this out to a weekly view as well, where I think what we're seeing is this nice, stable, range-bound oil price over the last couple of years. And of course, there's a lot of speculation with geopolitical conflicts that this could change, that the picture could move sharply in one direction or the other. But I think for markets, stabilization of the oil prices is certainly helpful. That nobody likes uncertainty, right?
That's right.
Let's move our eyes over to a chart of gold, which I've talked to a lot of really smart macroeconomists talking about central bank seizure of more gold assets as U.S. sanctions against nations like Russia have put gold back on central bankers' radar as a store of value for their own fiat currencies. So let's talk about what's happened with gold just in the last couple of weeks here from a trend perspective.
Yeah, gold, we know what, well, we, and people might, but as technicians, we want to make sure we also look at the chart. And we know what the big factors are that are impacting prices of gold. But just from looking at the chart, you can get so much valuable information. And we can throw this back in a minute to that monthly chart that we like to look at. But since this move a couple of months ago, what we've really wanted to see is stabilization at these higher levels, because once you break out, you're really then looking for the areas that you've broken out from to be support going forward. And so what's been really good for gold over the last couple of weeks is that we've seen that weakness, and then we've seen some stabilization. So this is it's going to be an interesting moment. We've seen the trend colors go weaker. We've seen it pull back from these counter trend correction arrow here that we saw at the top. But now we've seen stronger blue bars again as price seems to have put in a higher low. Oscillator dipped below the 0 line, which was a bit of a concern, but is now right back at that level on these strong blue bars. So it'll be interesting to see now if we can get back into positive territory. That'll be a good sign for gold.
Absolutely. And last one to pull up, let's take a look at the VIX, $VIX, because we have seen some move in the volatility over the last couple of weeks.
Yeah.
And look where we are now.
Yeah, volatility now in a no-go trend. So we had that real sort of rising volatility, which led to, which was sort of coincided with the falling equity prices. You can see how we've really fallen away now over the last 2 or 3 weeks, and we're in a no-go trend for volatility.
Absolutely. Now, one of the tools that we like to use at GoNoGo Charts are these heat maps and relative strength heat maps. Before we move to our sectors of the U.S. equity market, let's take a look at the global equities relative strength heat map. One of the things that a lot of investors suffer from is a home bias. I do as well. I think mostly about U.S. stocks and not about a lot of other areas of the world. But we've seen the Italian markets breaking out. We've seen the Japan market really strong. We've seen Indian markets really on a tear for the last couple of years. So it helps as investors for us to take a look across the regions of the world. We can look at country level equity indices and compare them against the S&P 500. And that's the heat map that we're looking at right now, are the countries relative to the S&P to just see where there are areas of outperformance. And certainly, Alex, when I look at this map, I'm seeing quite a bit of aqua and blue in the top half of this map.
Yeah, still a lot of blue, and we've been seeing that now for the last few weeks. That change, you can see if you move your eyes to the left of the chart, then it was a U.S. equity market, right? That's where we wanted to be. That's where the returns were. You can see every country relative to the U.S. underperforming, and you can see as we move through the timeline on this chart, that's starting to change with different countries coming in. And now, yeah, like you said, a lot of blue here on the right, really sort of globally outperforming the U.S. markets.
So top panel, we've got the Eurozone. Second panel is the IBEX, the Spanish index. We've got the United Kingdom in the third panel. And then as we move down the list, you can see China outperforming the US markets down here, MCHI. We've got the Hong Kong market just below that and Singapore just below that. So we've got multiple areas of the world outperforming, and I think one of the messages to all of us as investors is to keep an open mind. And I know that we get stuck in our rut. We're analyzing the same markets every day, all the time. But you like to say, Alex, if there's a trend somewhere, right? Jimmy Buffett knows that it's 5 o'clock somewhere, and so keeping an open mind to the fact that trends might exist in alternative asset classes or outside the US in terms of equity participation is just a helpful reminder. All right, but for today's show, let's go back to the S&P 500. And if you are a US only investor, there are still opportunities. And the way we find those is through this top-down approach. I'm going to start with this sector RelMap, looking at each of the 11 sector ETFs against the S&P 500 as the benchmark. And so each one of these panels is a ratio chart, just like that global relative strength heat map. Alex, top panels, we've got information technology, consumer discretionary and communications, pretty weak. Below that, we're finding some of the cyclical sectors of the economy. And then in the lower panels, the defensives. And I'm seeing a lot more health in the defensive sectors.
Yeah, it's a mixed bag. You know, we've certainly had a strong run over the last couple of weeks in the general equity prices. You know, the S&P moving higher, the other indexes as well, the Dow Jones, etc., moving higher. But it's a mixed bag when you get under the hood, as you like to say, right? We saw this. We've seen underperformance from the growth sectors for such a long time, really now. And then communications was sort of a beacon of hope. It rolled over. It tried to come back again into some sort of outperformance, and now it's once again in a relative no-go trend. So we're really not getting much in the way of help from the growth sectors, these top three panels. And then we've got some, like you said, some of those cyclical sectors in the middle. We've got industrials, we've got financials, but we used to have energy and materials as well. So energy and materials have rolled over into no-go trends. And then the defensive sectors that have been in the relative outperformance now for a couple of weeks remaining in those go trends. So, you know, it's not as pretty as it looks sometimes, right? And you see the really strong run this week. Maybe that's why we're seeing the uncertainty in the stock market still. Maybe why we haven't gone to go colors just yet, because there's a bit of a mixed bag.
Absolutely. The characteristics of defensive sectors leading the market, inherently bearish. If investors are allocating to consumer staples and utilities companies, those are the things that never get cut from the monthly household budget. Alex, what our next step usually entails is getting into the industry groups that are leading these sectors. Let's take a look at a couple today. We could start with utilities. We've been looking at this on several of these weekly shows recently, and we know that most of the leadership, at least over the last couple of months for utilities, has been coming strictly from electrical companies. Over the weekend at my godson's first communion, I did get to talk to a 38-year veteran of Con Ed who worked solely on the grid. And it's fascinating to hear his perspective on just how intense the load of demand has become as everybody's charging EV vehicles. We've got electric only homes. We're moving away from nat gas wherever possible and looking for cleaner sources of energy. So electrical utilities companies leading the utility sector higher. Let's take a look as well at the industrial sector, Alex.
Yeah. And Tyler, before we move on, just to point out, we were talking about how the leadership within the utilities was solely from conventional electricity, but the water index here has come in as well. So instead of maybe tailing off, perhaps the utilities groups picking up in terms of outperformance. So again, a slightly bearish indication there.
Absolutely. And within the industrial sector, we have a lot of industry groups and more widespread leadership that's pulling industrials higher. I'm not going to pretend that I know exactly what each of those multiple letter acronyms are for the indices, but we can see that the industrials sector is being led by a number of areas.
Yeah.
We've looked at aerospace and defense. We've looked at companies like Raytheon that have been, solid breakout over the last.
We looked at marine transportation as well. I think performing well here in the fourth panel.
Absolutely. Now, to end today's show, I think we want to give the people what they want, Alex, which is a look again at some of those mega cap tech names that perhaps reached a bottoming process, perhaps have a buying opportunity. So let's go through a couple of the darlings. Yep. Let's start with Apple.
Yeah, Apple's had a really good run this week, gapped higher, obviously, on I think this was Monday, and has been able to hold at that level. What we're going to really watch for here, Tyler, and one of the things that we really love about using GoNoGo Charts is that you've got your one price panel, and you don't have all of the other components that you might typically put on there in terms of lines and indicators and whatnot. So you can see things jumping off the chart. So for me, really quickly, what I see just right away is that we've gapped higher than an important level that's been support here and resistance here. So it'll be important now to see if we can hold this level. This could be support going forward. And of course, you can see that here on the chart with the horizontal line. So emerged out of its no-go trend. And we could see, again, sorry, I'm going to keep going here. Why not?
Keep going. Let's do the classical technical analysis, Alex. I love it.
Traditional technical analysis. We are both big fans of it, and you can do it on these charts because you try to keep the chart simple without a whole load of indicators and annotation and other panels below the chart. So what are we seeing here? Hands up at home. This is bullish divergence, oscillator making higher lows as price made lower lows. You can see how the oscillator for us, importantly, started to struggle to stay below the zero line. We know that in a no-go trend, it should be at or below zero. Then when it breaks above and finds support, just a couple of bars before that gap, the darker color, Tyler, of course, for everybody at home, that tells us that there was heavy volume coming in here as well. So this was interesting. We broke above zero, we retested, and we saw heavier than average volume as the prices attempted to make that gap. So you've got a lot of things here to be happy about if you're an Apple investor. We should be able to look for support at this level going forward. We've got strengthening go bars, oscillator in positive territory on heavy volume.
Fantastic. Now, like a team that was down at the first half, we are coming back into trend. Alex, let's talk about areas of potential resistance as price action climbs back higher. We could look at this on a weekly basis as well if you'd prefer.
Either one. I mean, there's definitely these prior highs here. Those are going to be areas of resistance. Let's bounce this out and see what it looks like on the weekly. Yeah, you've got very strong resistance here, but that's some way off. We'll see what we can do here. And interestingly, the weekly is in amber goldfish bars, so we'll be watching to see if the oscillator gets above zero. With Apple, it's always fun to look at it on a monthly chart as well, Tyler, because it's been such an amazing trend for all of these years. And so what you really want to see now in terms of long-term perspective for Apple, we are butting up against these all-time highs, not quite yet, but they are right there. So we need to be aware of those. And then look at this. This is going to be very important. Again, we won't know the resolution of this for sort of 3, 4, 5 months, but will we find support here at zero on the monthly chart? If this zero level holds, then we're going to be looking at Apple trying to make new highs over the next 6 months or so. But very, very amazing trend when you look at Apple on a really long-term chart.
I appreciate you using a logarithmic scale over there for price action on the right side. When you're looking at very long-term charts, everybody, those moves at higher and higher price levels as a percentage basis for the stock really distorts the context of how important each new move is at these ever higher prices. And when we look at 2013, that was not the great financial crisis, that was not the COVID pandemic, but that pullback in Apple could have been a career-ending move for some portfolio managers if they weren't managing risk. Remember, these are monthly bars, and that is a steady downtrend for quite some time.
Yeah.
So in context, what we have seen in Apple over the last couple of months, minuscule by comparison.
Right.
All right. Alex, let's do one more to wrap up today's show. Let's take a look at NVIDIA.
Yeah, NVIDIA held on sort of much better than Apple, obviously.
Yep.
And it's come out of its shorter no-go correction already. It wasn't even that deep. If you remember the Apple chart, this is sort of more of a sideways move. Of course, we have pulled back against this high here, and we did enter the no-go trend. You can see how the oscillator failed at the zero level again. Same principles apply. If you can really sort of understand very simply 3 or 4 things we're trying to show here with every GoNoGo chart. When in the Go trend, oscillator finds support at the zero level, tells us, okay, trend continuation likely, relatively safe entry points throughout this trend. When that doesn't happen towards the end, the oscillator breaks below zero and then starts to retest it and find rejection at that level, then now we know that there's a bit more of a threat to this Go trend. Of course, then we enter the no-go, but quickly regain positive territory on the oscillator. You can see that squeeze build telling us that there's some tug of war happening. And you can see that with the amber bars coming in as well. Right? Very uncertain period here. No-go didn't really take off. We saw the amber bars come back. And then, of course, the oscillator break back above zero ahead of the trend color change. So there's a lot being said there in a short period of time. But we're back in a Go trend painting strong blue bars, oscillator above zero in positive territory. Now, of course, we do have some prior high resistance on the chart, so we'll keep an eye out for that.
Absolutely. Alex, as always, it is a pleasure to talk markets in these simple, elegant visual tools. I hope that for everybody who is watching, you go ahead and subscribe to the GoNoGo Charts channel. If you've got any questions for us, how these are constructed, where you can get a hold of our subscription research or more educational videos that explain these core technical concepts and the use of GoNoGo Charts, shoot us an email, info@gonogocharts.com. You'll find us on Twitter and LinkedIn and all the social handles as well when you're looking for GoNoGo Charts. And until next week, take care of each other and trade them well.